The silver decline from $121 to $64 wasn't what most people believed it to be. It wasn't the conclusion of the bull market. It wasn't a bubble bursting. It wasn't evidence that silver was excessively valued. I understand that's what the headlines suggested. I understand that's what your instincts told you as you watched your investments decline for days. But I dedicated the past week to analyzing data from sources that most individual investors never examine. And what I discovered completely transformed my comprehension of what actually occurred, because the decline wasn't triggered by knowledgeable silver investors selling their positions. It was triggered by individuals gambling on silver with borrowed capital being compelled to liquidate whether they wanted to or not. And once you witness the data I'm about to present, you'll never view a silver price decline the same way again. If this type of analysis is what you've been seeking, hit subscribe. I examine what mainstream financial media won't address and drop the phrase "silver to the moon" in the comments so I know this community recognizes what I recognize. Let me begin with something that required an embarrassingly long time for me to comprehend about the silver futures market. And frankly, I believe most individual investors have no awareness this is how it operates. On the COMEX, which is the primary silver futures exchange in the United States, certain traders control their entire silver position with merely 5 cents of their own capital and 95 cents borrowed. Read that once more. 5% of their own funds, 95% borrowed. That's roughly 19 times leverage. To express that in terms anyone can comprehend, imagine you possess $1,000. With 19 times leverage, you're controlling a $19,000 silver position. If silver rises 5%, you just doubled your capital. Sounds excellent, correct? But if silver declines 5%, your entire $1,000 is eliminated, obliterated. And here's the crucial part. When that occurs, you don't get to remain there and wait for a recovery. The exchange compels you out. It's termed a margin call. And when sufficient traders receive margin calls simultaneously, their forced liquidation pushes the price down further, which triggers additional margin calls on other traders, which compels more liquidation, which pushes the price down even more. It's a cascade, a domino effect, a mechanical waterfall of liquidation that has absolutely nothing to do with whether silver is actually worth less than it was yesterday. That's precisely what occurred in the decline from 121 to 64. And I want to ensure you genuinely comprehend how violent this process is because the numbers are staggering. When margins increased from 5% to 8%, certain traders immediately encountered financial difficulty and were compelled to liquidate. Then margins moved to 11%, more forced liquidation, then 15%, more liquidation, then 18%. By that point, anyone who had been excessively aggressive with leverage was completely eliminated. Each wave of margin increases created a fresh wave of forced sellers, and each wave of forced sellers pushed the price lower, which made the subsequent wave of margin calls even more devastating. It's like dominoes falling in a circle. Each one knocks down the next, and the process feeds on itself until there's no one remaining to knock down. Consider it this way. Imagine a crowded theater where someone yells fire. Everyone rushes for the exit simultaneously. They're not departing because the movie is poor. They're departing because everyone else is departing and the doors are narrow. The movie is still playing. The theater is still standing. But the stampede makes it appear like the entire building is collapsing. That's what occurred to silver. The movie, which is the fundamental supply and demand picture, never changed. The theater, which is the physical market, is still standing. It was simply a stampede of over-leveraged speculators all attempting to fit through the same exit simultaneously. Now let me present you the evidence because I'm not requesting you to accept my word for it. I pulled the open interest data from COMEX Silver Futures, and the chart conveys the entire narrative. Open interest is the total number of outstanding futures contracts. It indicates how many positions are currently active in the market. When silver was peaking near its highs, open interest reached approximately 176,000 contracts. That was the maximum number of traders with active positions. Fast forward to after the decline. Open interest has dropped to roughly 137,000 contracts. That means approximately 39,000 contracts were closed during the decline. 39,000 positions that no longer exist. Those weren't long-term investors collectively deciding to secure profits. Those were leveraged speculators being compelled out by margin calls. And here's why that's incredibly bullish. When the weak hands depart, the strong hands remain. The individuals still holding silver futures right now are the ones who could afford the volatility, the ones with genuine capital behind their positions, who aren't going to panic sell on the next 5% decline. The market just cleaned itself, and a clean market is a launch pad. I also want you to notice something specific about where many of these speculators exited. A substantial number of them closed their positions around the $50 level, and that makes sense when you consider it. $50 was the peak in 1980, $50 was the peak in 2011. For 50 years, $50 was the ceiling. So when silver came back down through that level during the decline, anyone who had been watching silver for decades saw it as a natural exit point. They locked in strong profits and stepped aside. But here's the significant part. If silver now forms a higher low above $50, $60 or $70, Those same traders have every reason to step back in. They secured profits at a level that made sense to them. And if silver proves that the old ceiling has become the new floor, they become buyers again on the next move higher. That's not a bearish setup. That's a massive pool of potential buying power waiting on the sidelines. But I didn't stop there because I wanted to know if this was exclusively an American phenomenon or if the same thing occurred globally. So I pulled the open interest data from China's silver futures market, and the chart displays the exact same pattern, the exact same spike in open interest during the rally, and the exact same collapse in open interest during the decline. This wasn't one exchange having a poor day. This was a global flush of leveraged speculators happening simultaneously on two continents. When I witnessed both charts side by side, I knew this decline was mechanical, not fundamental. The gamblers got eliminated. The silver didn't change. The demand didn't change. The supply deficit didn't change. Only the leverage changed. Now here's where my research took a direction that genuinely surprised me because I wanted to examine beyond the futures market. I wanted to observe what was happening in the physical silver market, the real market where actual metal changes hands between professionals who utilize silver every single day. And what I discovered made the futures decline look almost irrelevant. I pulled the lease rate data from the London silver market. Now, if you've never heard of lease rates, let me explain because this is critical and almost nobody discusses it. London is the largest trading hub in the world for physical silver. Professional participants there don't just buy and sell silver, they also lend it to each other. This occurs constantly. One participant needs to deliver silver next week but doesn't possess it yet. Another participant has silver sitting in a vault that won't be needed for a month, so they lend it. The rate they charge for this loan is the lease rate. In a normal healthy market with plenty of physical silver available, the 1-month lease rate hovers around 0%. Sometimes slightly positive, sometimes slightly negative. Anything above 1% is already considered stress. Do you want to know what the lease rate is right now? 4.5%. Let that number sink in. 4.5% for a 1-month silver loan. I examined the historical data. In 2023 and 2024, the lease rate was flat at 0, completely calm, no stress, no tightness, and now it's at 4.5%. That's not a red flag. That's a 5-alarm fire. It's the physical silver market screaming at you that there isn't sufficient metal to go around. While the futures market was declining and every headline was telling you silver is finished, the professionals in London who actually handled the metal were paying historically extreme rates just to borrow it for 30 days. Do you comprehend the disconnect? The paper price indicates silver is declining. The physical market indicates we cannot get sufficient of it. One of these is lying. And I can tell you it's not the professionals who actually need the metal. But wait, there's another data point that affected me even harder. And this is the one that I genuinely believe most investors, even experienced ones, have never examined. It's termed the 1-year silver swap rate minus US interest rates. I know that sounds complicated, but remain with me because I'm going to explain it in the simplest way possible. In a normal market, if you purchase silver today and agree to sell it in 1 year, the price you sell it at is slightly higher than today's price. Why? Because holding silver for a year costs money. Storage, insurance, opportunity cost on your capital. That cost gets incorporated into the forward price. This is termed contango, and it means everything is fine. There's plenty of silver, no rush, no urgency. Take your time. Now, when this relationship flips, when the price for silver delivered today becomes higher than the price for silver delivered in a year, that's termed backwardation. And it's deeply abnormal for a storable commodity like silver. It means buyers are so desperate for physical metal right now that they're willing to pay a premium just to get it immediately instead of waiting. They're literally saying, like, take my silver today and I'll pay you extra because I need it now and I cannot wait. And right now we're not just in backwardation, we're in extreme backwardation. The deepest level I can find in modern data. The 1-year silver swap minus US interest rates is sitting at approximately 3.5. That number should be positive. It's deeply negative. The physical market isn't whispering, it's screaming. Now let me connect this to something I covered in previous analysis because this is where all the threads come together. I've been tracking the inventory data at COMEX and in Shanghai for weeks, and both charts continue to decline. Let me walk you through precisely what I observe. The COMEX silver inventory chart displays a consistent staircase pattern downward. Every week, less metal. Every month, less metal. The current registered inventory has dropped to its lowest level in months, down from roughly double that amount just 6 months ago. The metal is departing and it's not returning. No reversal, no stabilization, just a steady, relentless decline. The Shanghai inventory chart displays the same thing. From a peak of over 1.2 million, the number has collapsed to approximately 350,000. The SHF vaults were draining at 42 tons per week. That drain hasn't stopped. If anything, it's intensified. So let me ask you a question. If silver just declined 50% and the bull market is finished, why are inventories still falling? If demand has dried up, Why is there less metal in the vaults today than there was before the decline? If nobody wants silver anymore, why are lease rates in London at levels we've never witnessed before? If the trade is dead, why is the physical market in the most extreme backwardation in modern history? The answer is obvious. The decline wasn't about demand. The decline was about leverage. Let me paint you a picture of what actually occurred step by step because I believe the sequence matters. Step 1. Silver rallied from $37 to $121 over several months. During that rally, speculators piled into COMEX futures with massive leverage, some with as little as 5% of their own capital. Open interest surged to 176,000 contracts. Step 2. Volatility increased as the price moved faster. When volatility increases, exchanges raise margin requirements. This isn't manipulation. This is a standard mechanical process designed to reduce systemic risk. Margins went from 5% to 8%, then 11%, then 15%, then 18%. Step 3. Each margin increase compelled the most leveraged traders to either deposit more capital or close their positions. Most of them couldn't deposit more, so they sold. Their selling pushed the price down. The lower price triggered margin calls on other traders who had slightly more cushion. They sold too, and the cascade began. Step 4. In a matter of days, silver went from 121 to 64. 39,000 futures contracts were liquidated. The reckless cowboys were flushed out of the market. Not because silver became worthless, because they were gambling with borrowed money and the music stopped. Step 5. And this is where we are right now. The speculators are gone. Open interest is at its lowest level in months. The market is now held by participants with genuine capital, genuine conviction, and genuine reasons to own silver. And every single indicator in the physical market, lease rates, backwardation, inventory levels, is telling you that the actual metal is more scarce and more in demand than it was before the decline. Consider what that means. The price is lower, but the physical tightness is higher. That's like a coiled spring. The further you push it down while the underlying pressure builds, the more violent the snapback when it releases. And there's something about commodity markets that most individuals who come from the stock market don't comprehend. In equities, when prices decline, demand usually dries up. Individuals get scared, they stop purchasing, they wait. Commodities work differently. In commodities, rising prices often increase urgency rather than fear. Buyers worry about securing supply at even higher prices tomorrow. They rush to purchase, not sell. And when prices decline due to a technical event like a leverage flush, the physical buyers don't disappear. They accelerate. Because to them, cheaper silver isn't a warning sign. It's a discount. The industrial buyer who needs silver for solar panels doesn't care about RSI charts. The mint that needs silver for coins doesn't check futures open interest before placing an order. They observe lower prices and they purchase more. That's precisely what the inventory data confirms. The price declined and the metal kept departing the vaults. The physical buyers treated the decline as a sale, and they're still purchasing. Now I want to address something directly to 3 groups of individuals watching this. If you sold during the decline, I comprehend that kind of move is terrifying, especially if you had a significant position. But I want you to examine the lease rate chart and the backwardation chart and ask yourself one question. Does a market that's this tight appear like a market that's finished going up, or does it appear like a market where the paper price temporarily disconnected from physical reality? If you held through the decline, the data indicates you made the correct decision. Not because the price went back up the next day, but because the structural picture underneath the price never broke. Inventories kept falling, lease rates kept climbing, backwardation kept deepening. The foundation of the bull market isn't the price on your screen, it's the physical tightness underneath it. And that tightness has only gotten more extreme since the decline. If you've been watching from the sidelines, this is the data you need to make your decision. I'm not going to tell you what to do, but I will tell you what the numbers indicate. The speculators who drove the decline are gone. The leverage that created the waterfall has been cleaned out. And the physical market is tighter than it's been at any point in this entire bull cycle. Here's what I anticipate to occur next based on what the data is displaying me. And I want to be clear that these are my observations, not guarantees. The area around $70 has a strong probability of becoming the new structural floor for silver. The reason is simple. The mechanism that pushed prices sharply lower, which was forced liquidation of leveraged futures positions, has largely been exhausted. Open interest has already collapsed. There aren't sufficient leveraged speculators remaining to create another cascade of that magnitude. Simultaneously, the forces that push prices higher, physical demand exceeding available supply, declining inventories, extreme backwardation, record lease rates, all remain firmly in place. The sellers have been flushed, the buyers are still there, and the metal is still disappearing from the vaults. Here's something you can verify yourself right now. Search Silver Lease Rate London. Examine the number. If it's still above 4%, you're examining a market that's in extreme physical stress. Now search Silver Backwardation 2026. Observe what appears, because when you verify this data on a screen that isn't mine, it affects differently. These aren't opinion pieces. These are market rates established by actual transactions between professional participants who collectively trade billions of dollars worth of silver every month. They cannot be fabricated. They cannot be manipulated by social media posts. They're the raw, unfiltered voice of the physical silver market. And right now, that voice is indicating one thing very clearly. There isn't sufficient silver. I also want you to comprehend how unusual this combination of signals is. I've been studying commodity markets for years, and I cannot find another period where open interest collapsed, while lease rates spiked, while backwardation deepened, while inventories declined, all simultaneously. Usually you get one or two of these. Maybe a spike in lease rates during a temporary squeeze, maybe declining inventories during a demand surge, but all four simultaneously during a price decline. That's not a market that's breaking down. That's a market that's coiling. And remember something crucial. Both the United States and China have taken extraordinary policy actions around silver in recent months. China implemented export controls on January 1st, 2026, restricting silver exports to just 44 approved companies and effectively trapping 60-70% of global refined silver supply inside its borders. The United States added silver to its list of critical minerals in November 2025. Governments don't designate a commodity as critical and strategic if it's abundant and unimportant. They do it because it's scarce and essential. Both of the world's largest economies are now treating silver as a strategic resource, and the inventories on their exchanges are declining simultaneously. That's not a coincidence. That's a signal. Now, I need to be honest with you about risks because I never want to present one side without acknowledging the other. I hold silver, I have exposure in this situation, and there are scenarios where this thesis faces challenges. If lease rates in London fall back towards zero, that would signal that the physical tightness is easing. If the extreme backwardation normalizes and the market returns to contango, that would suggest the urgency for immediate physical delivery has faded. If inventories at COMEX and Shanghai begin to rise meaningfully, that would indicate new supply is entering the system. And over the longer term, higher silver prices will incentivize industrial users to find substitutes or efficiency gains, and increased copper production could bring additional silver supply to market since silver is often a byproduct of copper mining. I'm watching all of these indicators every single week, and if the data changes, my view will change with it. But right now, today, none of those conditions are present. Lease rates remain extreme. Backwardation is deep. Inventories continue to fall. The data hasn't changed. Only the price changed, and the price changed because of leverage, not fundamentals. There's also something significant happening in silver mining stocks that I want to flag. Mining stocks are still priced as if the decline proves the bull market is finished. They're trading at valuations that assume silver at $50 is as favorable as it gets and that every parabolic move ends in a permanent collapse. But if I'm correct that $70 becomes the new floor and the physical market remains this tight, mining stocks haven't yet priced in the new reality. They're still stuck in the old one. And when the market realizes that the floor has moved up by 40% from the old $50 ceiling, the repricing in miners could be violent in a favorable way. Let me bring this full circle. I want you to consider what you just heard in the context of what has been shown previously. Silver vaults in Shanghai, New York, and London are all draining simultaneously for the first time in modern history. The 5 to 7 month surge pattern has produced triple-digit percentage gains twice before, and we're currently in month 2 of that pattern. And now I've shown you why the decline that scared everyone wasn't a breakdown in the bull case. It was a leverage flush that left the physical market even tighter than before. The paper price declined. The physical market got tighter. The speculators departed. The strong hands stayed. The inventories kept falling. The lease rates kept climbing. The backwardation kept deepening. Everything that matters for the long-term case got stronger during the decline, not weaker. The only thing that got weaker was the confidence of individuals who don't examine this data. 5 years from now, individuals will study this decline as a textbook example of how leveraged futures markets can temporarily disconnect from physical reality. They'll point to the lease rate chart and the backwardation chart, and they'll indicate it was obvious in hindsight that the decline was a mechanical event, not a fundamental one, that the strong hands who held through it were rewarded, and that the genuine signal wasn't the price falling. The genuine signal was the physical market refusing to confirm the decline. I'll keep tracking every data point, every lease rate update, every inventory report, every backwardation reading, and I'll be here to walk you through what they mean as this story continues to unfold. If this changed how you see the silver decline, share your thoughts in the comments. Send this to one individual who panicked and sold during the decline. They need to observe this data before they make their next decision. The decline wasn't the end of the narrative. It was the reset before the next chapter. The speculators are gone, the metal is still departing the vaults, and the physical market has never been this tight. The question isn't whether silver recovers. The question is whether you're positioned when it does.